Hello everyone, welcome to EPK Capital's deep dive video. In this series we analyze one company each day based on the security analysis by Benjamin Graham. Today we are going to talk about Salesforce. For more than 2 decades, Salesforce has not only pioneered the cloud computing model but has fundamentally reshaped how businesses manage their customer relationships. The company's impressive growth since its founding has culminated in its inclusion in the prestigious Dow Jones Industrial Average, a move that placed it alongside some of the world's most stable and recognized corporate giants. Today, Salesforce commands a massive market capitalization, cementing its position as a dominant force in the software industry. However, this new identity as a Dow component presents a fascinating paradox. For years, Salesforce was a quintessential high-growth tech stock, valued for its top-line expansion at all costs. Now, the market is evaluating it through a different lens, one that scrutinizes profitability, financial discipline, and sustainable growth. This analysis will explore this evolving narrative, investigating whether Salesforce's past performance and future strategy align with its newfound status as a blue-chip tech stock. This report is designed to provide a comprehensive, neutral overview, empowering you with the knowledge to form your own informed opinion. The company and its promoters, the story behind the stock, the origin story, from an apartment to no software. Every great company has a founding story that defines its mission, and for Salesforce, it began in a one-bedroom apartment in San Francisco in March 1999. The company was co-founded by former Oracle executive Marc Benioff, along with Parker Harris, Frank Dominguez, and Dave Meelenhoff. Their audacious goal was to completely reinvent business software. At a time when enterprise applications were cumbersome, expensive, and required complex on-premise installations, the founders envisioned a new, revolutionary model, software as a service, or SaaS. Their idea was simple yet radical: to deliver business applications directly through a website, making them as easy to use as Amazon.com. Within a month, a prototype was up and running, and by November 1999, the small team was already outgrowing its initial space, a clear sign of the demand for their new approach. The company's revolutionary vision was perfectly encapsulated in its now iconic and controversial No Software marketing campaign. The campaign positioned Salesforce as a disruptive force, using aggressive imagery, such as a fighter jet shooting down a biplane, to symbolize its technological superiority over the obsolete software industry that came before it. This bold stance not only captured attention but also cemented Salesforce's brand identity as a modern, nimble alternative to industry incumbents. Key milestones in the Ahana culture. From its humble beginnings, Salesforce's journey has been marked by significant milestones. In June 2004, the company successfully completed its initial public offering on the New York Stock Exchange under the ticker CRM, raising $110 million and setting the stage for its public life. A cornerstone of the company's identity is its corporate culture, known as Ahana, a Hawaiian concept that emphasizes family, community, and collaboration. This philosophy is not just an internal slogan. It's a public-facing brand pillar that has defined its interactions with customers and the wider tech community. This culture is also at the heart of Dreamforce, the company's annual conference, which began in 2003 with just over 1,000 attendees and has since grown into a massive global event. Under Marc Benioff's leadership, this culture has been used to advance a very public, values-driven agenda. For instance, in September 2021, Benioff publicly stated that Salesforce would help any employee who wished to move out of Texas following the state's abortion legislation. While this kind of leadership can foster strong brand loyalty and attract like-minded talent, it also exposes the company to a broader set of social and political issues. This was evidenced by a senior manager's public resignation in 2021, alleging workplace discrimination. The company's strong public culture, therefore, introduces both a competitive advantage and a unique set of reputational risks, which are important for investors to consider. An investment in CRM is not just an investment in a software platform, it is an investment in a very specific corporate identity. A deep dive into the finances, a 10-year retrospective. To understand the investment case for Salesforce, it is crucial to move beyond its narrative and examine its financial performance over the last decade. The company's financial story is a classic tale of a high-growth software company, marked by both soaring revenue and a complex path to consistent profitability. Revenue growth, the engine of the Salesforce story. Salesforce's top-line performance over the past decade has been nothing short of spectacular. Its annual revenue has grown from $6.67 billion in fiscal year 2016 to an impressive $37.90 billion in fiscal year 2025. This represents a near six-fold increase over a period of 10 years. For most of this period, the company maintained an aggressive double-digit growth rate, consistently increasing revenue by over 20% year-over-year. This phenomenal growth engine was a primary reason for the stock's high valuation and investor excitement. However, a closer look at the data reveals a recent deceleration in this growth. The year-over-year growth rate peaked at over 28% in 2020 before steadily declining to 18.35% in 2023 and reaching a high single-digit rate of 8.72% in fiscal year 2025.6. This slowdown is to be expected for a company of Salesforce's immense scale and is a key factor in its maturation. This data suggests that the company's investment thesis is no longer solely about rapid, top-line growth but is shifting towards a new, more balanced strategy. Profitability, a story of fluctuations. The Salesforce story is not just about revenue, it is also about its journey toward consistent profitability. As a software-as-a-service provider, the company has consistently maintained high gross profit margins, averaging around 74.8% over the past 5 years. This is a hallmark of a capital-light business model where the cost of revenue is low. The real story, however, lies in its bottom line. For many years, Salesforce operated at a loss or with razor-thin profit margins. This was a deliberate strategy, as the company poured enormous resources into sales, marketing, and research and development to capture a dominant market position. The financial statements from fiscal years 2013 through 2016, for example, show the company operating at a loss or with near zero margins. This growth at all costs approach was a point of contention for many investors. However, a major shift occurred recently. After a significant spike in profitability in fiscal year 2021, the company's net income turned consistently positive in fiscal years 2024 and 2025, with net profit margins reaching 11.87% and 16.35% respectively. This pivot is a crucial signal. It indicates that management is now prioritizing sustainable, profitable growth, demonstrating that the company's scale can finally translate into a healthy bottom line. Financial health, debt and cash flow. A thorough financial analysis must also consider the company's balance sheet and its ability to generate cash. Salesforce's long-term debt has seen a significant increase in recent years, reaching over $10 billion in 2022. This rise is directly correlated with the company's aggressive, multi-billion-dollar acquisition strategy, which has included deals for Slack, Tableau, and most recently, Informatica. Despite this increase in debt, the company remains in solid financial health. Its debt-to-equity ratio is low, at 0.19, which suggests that the company is not overly reliant on borrowed funds to finance its operations. This is largely due to its strong ability to generate free cash flow. Salesforce's recurring, subscription-based revenue model provides a predictable stream of cash, which has grown substantially in recent years, reaching $9.498 billion in fiscal year 2024 and $12.4 billion in 2025. This robust cash flow acts as a crucial buffer, allowing the company to fund its strategic acquisitions and repay its debt without jeopardizing its financial stability. The strength of its cash position provides a significant margin of safety for the enterprise as it navigates its next phase of growth. Stock chart, technical analysis, decoding the CRM stock chart. A fundamental analysis of a company is incomplete without understanding how the market has reacted to its performance. A look at the technical chart for Salesforce reveals a period of high volatility and a recent shift in investor sentiment. the stock reached its all-time high of $366. In December 2024, a peak that likely reflected maximum optimism about the company's strategic vision and its investments in AI. However, in the months that followed, the stock experienced a significant pullback. This downward price action has resulted in the stock breaking through the ceiling of a falling trend channel, which signals a potential slowdown in the rate of decline or the beginning of a horizontal price movement. 18 Furthermore, a rectangle formation sell signal has been detected, which typically indicates increasing pessimism among investors and suggests the stock may continue or enter a falling trend. It is important to understand that these technical signals are not definitive predictions but rather a visual representation of market psychology. The price action suggests that the market is re-evaluating the Salesforce story in the face of its slowing growth and other macroeconomic factors, such as higher interest rates, which could negatively impact the stock. For technical traders, key levels to watch include the support at $237 and the resistance at $272. The stock's 52-week high stands at $369, while its 52-week low is at $226, which helps frame the current trading range. With a beta of 1.22, the stock is 22% more volatile than the broader S&P 500 market. This heightened volatility means that movements in the overall market tend to have a larger impact on Salesforce's stock price, a crucial factor for risk management. The Benjamin Graham valuation, an old-school approach. In the world of value investing, Benjamin Graham's valuation formula is a classic tool used to determine a company's intrinsic value independent of market fluctuations and sentiment. 20 Graham, the mentor of legendary investor Warren Buffett, developed this formula to help investors identify undervalued companies with a margin of safety. While its application to a high-growth tech company like Salesforce may seem counterintuitive, it provides a valuable perspective on the stock's valuation. To apply this formula to Salesforce, we need to gather the necessary data from our research. EPS (TTM), the normalized basic EPS for the latest 12 months is $5.38. Another source cites the TTM EPS as $6.89. We will use the more conservative normalized figure for this calculation. Expected growth rate, G. This is the most subjective variable. While Salesforce's past revenue CAGR is 21.6%, its recent growth is slowing. We will use a conservative, forward-looking estimate for future earnings growth. Based on analyst projections and recent trends, a rate of 12% seems reasonable to use for this example. AAA bond yield, Y. The current yield on Moody's seasoned AAA corporate bonds is 5.34%, while another source shows it at 4.61%. For our calculation, we will use a rounded average of 5%. Now, let's plug these numbers into the revised formula. Wait, that number is absurd. Why is our result so high? This is a crucial moment for a deep understanding of the formula. The issue lies with the historical context of the growth multiplier 2, which Graham never experienced with companies that had annual growth rates of well over 10%. This formula was designed for stable, defensive stocks with predictable earnings, not high-growth tech companies with volatile, non-cash-based accounting. Graham himself stated he did not favor this approach of selecting fast-growing companies and industries. A strict application of the formula to a company like Salesforce is fundamentally flawed and will almost always result in a highly distorted intrinsic value. Instead of drawing a conclusion from this flawed result, the analysis must pivot to the educational takeaway. The Graham formula is a framework, not a definitive tool for all companies. The purpose of this exercise is not to declare Salesforce overvalued, but to illustrate that a single valuation method is insufficient for a company in a high-growth sector. The lesson is to understand the tool's intended use and its limitations before applying it. Pros versus cons, dueling narratives. The investment narrative for Salesforce is not one-sided. There are powerful arguments for both a bullish and a bearish outlook. The bull case, the unassailable market leader. The bullish case for Salesforce is built on its undeniable market leadership and strong financial position. The company holds a commanding 23.9% of the global CRM market, more than its next four competitors combined. This is not just a statistical victory, it signifies a powerful competitive moat. Salesforce's subscription-based model creates a sticky ecosystem where customers, once integrated, face high switching costs as they adopt more of the company's products. Financially, the company is robust. It has consistently delivered double-digit revenue growth for years and has recently demonstrated an ability to generate significant net income. Its balance sheet is healthy, with low debt relative to its equity and an impressive ability to generate free cash flow. This financial strength provides the company with the flexibility to pursue strategic initiatives and weather economic downturns. Furthermore, the company is proactively leading the next wave of innovation with its focus on AI and data. Its data cloud and AI annual recurring revenue is growing at a remarkable 120% year-over-year. The recent acquisition of Informatica is viewed by supporters as a brilliant strategic move to build an AI-ready data foundation and compete head-on with rivals like Microsoft and Oracle. A significant majority of analysts share this optimism, with a consensus rating of buy or strong buy and a price target suggesting potential upside from current levels. The bear case: cracks in the armor. The bear case centers on Salesforce's maturing growth profile and its reliance on expensive acquisitions. Critics point to the clear deceleration of revenue growth, which has fallen from over 20% to the high single digits. While this is a normal part of a company's life cycle, it raises questions about the company's valuation, which still reflects high growth expectations. The company's acquisition strategy is a major point of contention. Critics argue that Salesforce has a costly acquisition addiction and that the $8 billion deal for Informatica is an admission that the company failed to build the necessary data capabilities organically. This is viewed by some as an expensive band-aid for a fragmented product architecture, with concerns about potential overlaps with previous acquisitions like MuleSoft and the difficulty of integrating disparate platforms. The competitive landscape is also becoming more intense. Salesforce faces a multi-front war with established tech giants like Microsoft, Oracle, and Adobe, who are building their own integrated ecosystems, as well as with nimble startups like HubSpot and Zendesk, who are disrupting the low end of the market. Finally, macroeconomic risks, such as higher interest rates and a potential economic downturn, could negatively impact the stock, especially among its small and mid-sized business customers, who may be more sensitive to a slowing economy. Critical considerations, beyond the core analysis: market position and competitive moat. Salesforce's market position is a critical factor in its investment appeal. The company is the undisputed leader in the CRM software market, holding over 22% of the global share in 2023. Its dominance extends across its core product offerings. The company's Sales Cloud commands a 38.3% market share, over 3 times its closest rival, Microsoft Dynamics 365 sales. Similarly, its Service Cloud holds a staggering 44.9% of its niche market. This market leadership creates a powerful competitive moat, as customers become increasingly embedded in its ecosystem. The stickiness of the platform is reflected in the fact that over 60% of the company's revenue now comes from pre-existing customers. However, the competition is fierce. The company is not only competing with other CRM vendors but also with tech giants like Microsoft, Oracle, and Adobe, who are building comprehensive, integrated cloud ecosystems that could threaten Salesforce's dominance. Microsoft, in particular, poses a major threat with its all-encompassing suite of business applications. This means that Salesforce's future success depends not just on maintaining its lead, but on successfully integrating its own ecosystem to deliver a unified, compelling value proposition that rivals the integrated platforms of its competitors. The Informatica acquisition, a two-sided coin. Salesforce's recent $8 billion acquisition of Informatica is arguably the most important strategic move for the company's future, and it has drawn mixed reactions from the market. On the one hand, a compelling argument can be made that the acquisition is a necessary and brilliant strategic move. In an AI-first world, A company's ability to deliver intelligent, trusted solutions depends on having a clean, unified data foundation. Informatica's expertise in data integration, quality, and governance addresses a critical pain point for Salesforce customers who have long struggled with fragmented data across their systems. This acquisition is designed to accelerate Salesforce's AI ambitions, making it a powerful contender in the AI-driven market against Microsoft and Oracle. On the other hand, a valid counterargument exists. Critics view the deal as a sign of desperation and an expensive admission that Salesforce failed to build these core data capabilities organically. They point to overlaps with previous acquisitions, such as MuleSoft, and question whether the company can successfully integrate these disparate tools without creating a technical nightmare. From a customer's perspective, this creates uncertainty about product roadmaps and could lead to new pricing models as Salesforce absorbs the acquisition costs. The integration is expected to be a multi-year process, creating a period of uncertainty for the company and its customers. Conclusion: the final outlook. Salesforce today is a company in transition. It is an enterprise software behemoth with a dominant market share, a high-growth subscription model, and a strong, cash-rich balance sheet. The company has successfully navigated its financial life cycle from a money-losing growth machine to a profitable enterprise. However, the analysis also reveals significant challenges. The era of hypergrowth is giving way to a more mature, lower-growth reality. The company's reliance on large, expensive acquisitions to maintain its competitive edge is a double-edged sword, viewed by some as brilliant strategy and by others as a costly admission of internal architectural fragmentation. The competition is intensifying on all fronts, from tech giants building integrated ecosystems to nimble startups carving out new market niches. Ultimately, the future success of Salesforce will depend on its ability to execute its ambitious AI and data strategy. Can it successfully integrate its acquisitions and prove to the market that its investments will reignite growth without sacrificing the profitability it has recently achieved? The company's future stock performance will likely be tied to how well it manages this delicate balance between top-line expansion and bottom-line discipline. An investment in CRM today requires a nuanced perspective, one that looks beyond its market dominance to its strategic execution and evolving financial identity as a maturing DAO component. And that's all we had for this video. Thanks for watching. If you found this video valuable, please hit the like button, subscribe to our channel, and let us know in the comments which company you'd like us to analyze next. Just a quick reminder that this video is for educational purpose only and should not be taken as financial advice. For your personal financial advice, kindly get in touch with us on details and description, or you can connect with your financial advisor.